morning. My name is Hendra. I'm from morning class B of accounting class, Economic Faculty, University of Panchabakti, Pontianak. I'm here this morning to talk to you about an accounting issue that we feel is of great importance. My objective is not to try and persuade you to take a stand on this issue, but I would like to try and present this accounting case on accounting to you in order to better educate all of you here on a very important accounting equations concern. I want to take this opportunity to thank you for allowing me, before all of accounting student, Economic Faculty, University of Panchabakti, for this English forum. Okay, my topic today is, what is accounting? Accounting is the process of identifying, measuring, and communicating economic information to permit informed judgment and decision by user of the information. Next, what is accounting equation and how it works? Accounting equation is the whole of financial accounting is based upon this very simple idea. You can see this more clearly if you switch asset and capital around to produce the alternative from the accounting equation. Asset, liabilities plus capital. And number 3, what is asset? Asset is the actual resources that are then in the business. Example for asset are 1. Cash in bank, 2. Account receivable, 3. Merchandise, inventory, and etc. Next, what is liabilities? Liabilities is the name given to the amounts owing to these people of this asset. Example liabilities are 1. Accounting payable, 2. Expense payable, and etc. What is owner equity? Owner equity is capital is often called the owner's equity or net worth. Well, capital is the amount of the resource supplied by the owner. Example is capital. Component of asset, liabilities, and owner's equity. Component of asset: 1. Cash, 2. Account receivable, 3. Stock of goods, 4. Merchandise, 5. Fund, 6. Store supplies, 7. Equipment, and etc. Component of liabilities: 1. Account payable, 2. Expense payable, 3. Loan, and etc. Component of owner's equity: capital, expense, withdrawal, and etc. Next, what is balance sheet? Balance sheets contain detail of asset, liabilities, and capital. Okay, this is the example of balance sheet. Component of balance sheet are asset, fixed asset and current asset, liabilities, and capital. And what is income statement? The income statement also report the excess of the revenue over the expense incurred. This exercise, the excess of the revenue over the expenses is called net income or net profit. Okay, next the example of income statement. Component of income statement are fixed and net sales. Expense: 1. Advertising expense, 2. Rent expense, 3. Supplies expense, 4. Assurance expense, and etc. Next, enter the following transaction completing the double entry in the books or for the month of May 2007. Okay, 1. Started in business with $10,000 in the bank. The effect are bank is increased $10,000 and keep it and capital is increased $10,000. Okay, number 2. Purchase of goods $219 and credit from agents. The effect are forecast in increased $219 and increased agents $219. And number 3, book pictures and fighting $1,115 paying by check. The effect are decreased in bank by $1,115 and decreased in pictures $1,115. Okay, next 5. Sold goods for cash $140. The effect are increased in cash by $114 and increased of sales by $140. Okay, next 6. Goods on credit $325 from Simulti. The effect are increased in purchase by $325 and increased in Simulti by $325. And next 10. Paid rent by cash $200. The effect are decreased in cash by $200 and increased in rent by $200. And next 12. Box stationery $45 paying in cash. The effect are decreased in cash by $45 and decreased in stationery by $45. And next 18. Goods returned to the gems $41. The effect are increased in the gems by $41 and increased in return out by $41. And next 21. Received rent of $25 by check for suburb of corner space. The effect are increased in bank by $25 and decreased in rent received by $25. 23. Sold goods on credit to G-Cross for $845. The effect are increased in sales by $845 and increased in G-Cross by $845. Okay, 25. Bought a pen paying by check $4,100. The effect are bank. The effect are decreased in bank $4,100 and increased in pen by $4,100. Next 30. Pay the month's wages by cash $360. The effect are decreased in cash by $360 and increased in wage by $360. And the proprietor took cash for his own personal use, $18. The effect are decreased in cash by $18 and increased in drawings by $80. Okay, next, what books are used by you in studying English for accounting? What do the books teach you? 1. Framework Business Accounting. 2. Principle of Accounting, Kurt Warren, Accounting and Edward G. 3. Wonderbar, Principle of Accounting, Carol Costa, Accounting in 24-hour and Above Principle Accounting. And what lessons have you got from studying English for accounting? From Mr. Adi Mursalin, my English teacher. 1. Framework Business Accounting, about accounting, accounting equation, double entries, income statement, and etc. 2. Principle of Accounting, Kurt Warren, Accounting Edward G. About Principle of Accounting. And 3. Wonderbar, Principle of Accounting, Carol Costa, Accounting in 24-hour, About Principle Accounting. And next, what is your opinion about R.D. Mursalin, SAM, and your lecture of accounting English? I think Mr. Adi teaches with passion and very different from other faculty in the term teaching and explaining and in terms of statement and action. Okay, look at this video.
What is accounting? Account means explain. Accounting is thus the process of providing explanations. In order to provide explanations, the accounting process records actions or events. These are called as transactions. Thus, accounting is the process of providing information about the transactions of a business. It is for this reason that accounting is called the language of business. It is the means of communicating information to various stakeholders of a business. What is a business? A business is a set of activities for making profit. Profit is expressed as a number, and this number is communicated to various stakeholders through accounting. Let's take a look at Joe's furniture factory. Joe buys logs of wood and processes them at his factory. He makes furniture and sells it to his customers. Joe buys logs of wood at $40 a piece. He spends about $10 in conversion and sells the furniture at $75, thereby making a profit of $25. This is Joe's furniture factory. Apart from Joe, the management and his employees are interested in knowing how much profit he has made. These people are collectively known as internal stakeholders. Joe also has bankers and other investors who have invested money in his business. They are collectively known as external stakeholders. Apart from Joe and his investors, Uncle Sam is keen on knowing how Joe has been performing. Thus, the government is the third stakeholder in any business. The internal stakeholders are providing information about the business in a language called as managerial accounting. The external stakeholders will provide information in a language called as financial accounting. Uncle Sam, the government, have provided information in a language called as tax accounting. Internal users are interested in knowing how the business is doing. For this, they need accurate information, and this accurate information is needed for prompt decision making. Uncle Sam, the government, is interested in knowing how much taxes are due. Businesses just want to show a poor picture to Uncle Sam, so that they could probably pay lower taxes. And hence, businesses show lower profits to Uncle Sam. External users are interested in knowing how much profits the business is making, So businesses tend to show a good picture to them by showing higher profits. Since businesses cannot use their own method of accounting, these businesses are required to talk a language using some standards called as GAAP. GAAP stands for Generally Accepted Accounting Principles. Similarly, to curb the practice of showing lower profits, there are standards or rules governing the tax accounting. These are called tax laws. An example of the tax law is the Internal Revenue Code. Summary. Accounting is a process of providing explanations. These explanations are given by recurring transactions. It is thus called the language of business. In any business, there are three stakeholders. For each stakeholder, the type of information required is different, and hence the accounting is different. For more such videos, please visit www.accountingchef.com.
Okay, video number 1. What is accounting? Account is explained. Accounting is the process explanation, process the action and transactions. Accounting is meaning communication information to the stakeholder and in business. What is business? Business is set up activity to make it profit. Profit is expressed in this number. Number is communicated rest stakeholders to accounting. Summary. Accounting is the process of providing explanation. These explanations are given by recording transaction. It is thus called the language of business. In any business, there are stakeholders. For each stakeholder, the type of information required is different and lens the accounting is different. Okay, this is video number 2.
I figure now is as good a time as any to learn about probably what most people focus the most on when they analyze companies, and that's the income statement. And the income statement is one of the three financial statements that you'll look at when you look at a company. There's the income statement, and the other two are the balance sheet, which I have drawn a lot in a lot of the other explanations I've done on the financial crisis and whatever else. And actually in this video, we're going to see how the income statement relates to the balance sheet. And of course, the last one, well, it's not of course, if you don't know it, is the cash flow statement. Cash flow statement. Cash flow statement. And we'll focus on that a little bit later because that's a little bit more nuanced relative to the income statement. So the income statement is literally just saying how much a company might earn in a given period, and it always was related to a period. So it would be, it could be an annual income statement. It could be for the year 2008. It could be a quarterly income statement. Those are usually the two types you see, but sometimes even there's monthly or 6-month income statements. And the general format is pretty consistent, although there is a lot of variation depending on what a business does. But in this video, I really just want to cover almost a plain vanilla income statement for a company that just sells a widget. So the first thing when you sell a widget is, you make it and you just sell it, right? You sell the widget. You give a customer a widget and they give you some money, right? And that money that they give you, and I'm not going to get too technical about the accounting right now, is considered revenue. Revenue. It's sometimes considered sales. And that's literally the money that they give you in a certain period of time. And some of you accountants out there is like, oh, well, no, that's not just the money that they give you. It's the money that you've earned in a certain period of time. And that's true. But for our sake, let's just say that when you give the widget, you have earned the money that they give you, and that's revenue sales. Later on, we'll talk about different ways to account revenue and sales. So let's say the revenue or the sales in this case in a given period, let's say that this is income statement for 2008. So over 2008, we sold, I don't know, let's say $3 million worth of widgets. Let me do same color. So let's say it's $3 million. And a lot of times when you look at income statements for companies, if you go to Yahoo Finance, you could do this right now. Instead of writing 3 million, you'll see 3,000 there. It's like, oh my God, this company, they're hardly selling anything. But it's kind of a standard is that they tend to write things in thousands. So 3,000 would be 3,000 thousands, which would be 3 million. And for really big companies, they actually sometimes write their numbers in millions. So if you saw 3,000 there, it would actually mean 3 billion. But we'll actually look at real income statements in the not too far off future. So that's how much money they give us. But that's not how much income we made, because there was a lot of cost that went into making that widget that we have to account for. It's not like when someone gives me $3 million, I can just say, oh, I made $3 million, let me just put it all in the bank, I'm done, that was all income. So the first thing that you tend to see on an income statement is the cost of those actual widgets, the cost of producing those widgets, and those and I'll put all my expenses in, let's do it in magenta. So it'll sometimes be written as cost of sales, cost of goods sold. And this is literally, well, there's two things. There's a variable cost, which is each widget, they might have used some amount of metal and some amount of energy to produce it, and some amount of paint if it's a painted widget. And so the cost of goods is literally how much did it cost to buy the metal and the paint and provide the electricity to make those $3 million worth of widgets. And then that's the variable cost. And then on top of that, you have the fixed cost, or the relatively fixed cost, where, just to have the factory open, it costs a certain amount of money every year, regardless of how many widgets you make. And we'll go into more detail on that. But for simplicity, let's say all of those costs of making the widgets were $1 million. So sometimes someone might say it's a $1 million cost. I like to, when I make models, I like to put a minus there so that I remember that that's a cost. Anything that detracts from income, I put as a minus. Anything that adds is a plus, although that's not necessarily the standard convention. Some people say, oh, it's a positive $1 million cost, which means you subtract. But either way, I think you get the point. And then if you subtract your costs from your revenue, or if you just add these two numbers, because this one is negative, you have your gross profit. Gross profit. In this case, it would be $2 million. $2 million. And this number tells you how much money did you make, or how much profit did you make just from selling these widgets. So the more widgets you sell in most circumstances, the larger this number is going to be. So this is your profit before all of the other expenses that a company has to incur, like the taxes and the CEO's salary, right? The CEO's salary doesn't go in here, right? Because the cost of making a widget the CEO doesn't go out there into the factory in most cases and actually help make the widget. So the CEO's salary or the CFO's salary or the headquarters in a nice skyscraper, that doesn't get factored in here. Or the marketing expense, right? You have to tell people, hey, we make good widgets. So none of that is factored in here. So that goes into the next line, and oftentimes you'll see it broken up where it's, they'll have marketing expense, Sometimes they'll have, sometimes you have to pay salespeople, so you might have sales expense, sales. And then the stuff like the corporate office and the CEO's salary, and you have to hire auditors and accountants and all of that. That might be included as general. Actually, I should be doing this in magenta because it's all expenses, marketing, sales. And then G&A, you'll sometimes see. Sometimes you'll see SG&A. G&A just stands for General and Administrative Expenses. If you see SG&A, sometimes instead of that you see SG&A. That means Selling, General, and Administrative Expenses. Selling is things like, it could be the commissions that the salespeople get. It could be just the cost of having salespeople travel around the country and taking people out to steak dinners. And then the general and administrative, that's just all the stuff that the corporate office does and all of the people who are at that level. So if you subtract these, and I'm just making up these numbers as I go, say marketing, the company is spending, let's say it's $500,000. And I'm putting it as a minus because I like to remember it's an expense. Some models you'll see, they'll just write it, they'll say it's $500,000 expense. Sales, let's say this is just G&A here. I want to make a separate line for sales. So let's say sales, selling expenses is $200,000. And let's say G&A, the corporate offices and all of that, let's say that's another $300,000. $300,000. And now we're ready to figure out how much money did the operations of this business make. So this is operating profit. Operating profit. This is really important to pay attention to because so many people say, oh, a company made this much, and you'll hear these numbers, gross and operating profit and net profit and pre-tax profit, and it's very hard to understand that these are actually very, very different things because they all have the word in profit and, what does gross and operating and all of that mean? But here you see it means very, very different things. And let's calculate this number first before I go off on one of my tangents on all the differences between the operating and the gross profit. But let's see, 2 million minus, let's see, 1 million. My head, I think, implicitly made the numbers work out nicely. So my operating profit here is $1 million. So already we have some nuance on top profit. I made $2 million just from actual widget sales, but then when you take out all of the overhead of the company, the marketing, the sales, the general and administrative expenses, I'm only left with $1 million. And this is the profit from the operations of the company, or you could say from the assets or from the business or from the enterprise of the company. That's what is generating. But we can see, I've drawn a bunch of balance sheets before, and I think this is a good time to draw a balance sheet. So you have kind of the assets of a company. And we'll talk a little bit more about assets and enterprise value, and there's a little bit of a nuance there. But essentially the company itself, before you think about how the company is paid for or how it's funded, if you just think about the enterprise itself, the assets are generating this, right? They're generating the operating profit, and that's a very important thing to realize in the future when we talk about return on asset. Actually, we could talk about it now. If let's say our assets, if we paid, let's say $10 million for these assets, and these assets, this is the income statement for 2008, are spitting out $1 million a year, or at least $1 million in this year. Our return on asset, I wasn't planning on introducing this, but it doesn't hurt to introduce it right now. Our return on asset, often acronymed ROA, return on asset, would be, well, the numerator is the return, which is $1 million, 1 million. The denominator is the assets, 10 million. So we got a 10% return on our assets, right? For $10 million investment, we're getting $1 million a year. We're getting 10% of our asset investment back every year. So that's a nice thing to keep in the back of your mind, this return on asset concept. And it's very closely tied to operating profit and the actual assets of a firm. What we've learned, and especially if you watch some of my other economics videos, that all companies aren't financed the same. A lot of them might have some debt. So let's say that company had $10 million of assets, but let's say they paid for it with $5 million of debt. $5 million of debt. And let's say the interest rate on that debt is, I don't know, maybe think of a good number. Let's say the interest rate on that debt is 5%. So let me make it, let's make it 5%. I don't make it easier. I'll make it 10% interest, right? So this is their operating profit. This is the money that just comes out of the asset itself. But of course, that's not the money that we get to take home because we have to pay this interest. So let's throw that in there as an expense. Interest expense. And obviously a company that has no debt will have no interest expense. But in this case we do, and this is an annual income statement. So let's see, we have $5 million of debt, and we're paying 10% on that. 10% of $5 million is $500,000 a year in interest. So we have to essentially take half of our operating profit and give it back to the bank. And now we are left with we're getting close to where we need to get to. We're left with our pre-tax income. Pre-tax income. And if we do the subtraction, we're at $500,000. $500,000. And you could guess what the next line is going to be, given that this says pre-tax. This is what the owners of the company get before they pay the government, right? So you could guess what the next line is. It's going to be taxes. Taxes. Let's say that it's a 30% corporate tax rate. So 30%, and you're going to take 30% of this number right here. 30% of that number right there. So 30% of $500,000 is $150,000. $150,000. And then we are done. We finally have paid off everybody we need to pay off. So we started off with $3 million up here. We kept paying a bunch of expenses. And then now we're left with what? This is $350,000. $350,000 of net income. Net income. And this is what goes to the owners of the company. This net income right here. So going back to our balance sheet, we had the $10 million asset. We had $5 million of debt. We know what's left over is the equity. So let me do that in a vibrant color. Equity is what's left over. So let's say this is all book value. So we have $5 million of equity. And when I say book value, that's just a fancy way of saying this is what our accountants say that we paid for the stuff. This is what we have on our books. And we'll talk later about depreciation and amortization and how we might change what these values are. But a very simple way is if you went out and bought $10 million worth of stuff, you'd write on your books, I have a $10 million asset. And if you took a $5 million loan, then what you really own, if you were to kind of sell all of this, you would get $5 million of equity. And now this is an interesting thing. When we did return on asset, we looked at the operating profit because this is what our company generated before we paid the bank or Uncle Sam or anything like that. And so we took this number as a numerator and we divided by the number of assets. Now we can do another notion, and that's return on equity. Return on equity. So return on equity. And return on equity, the numerator is the net income that we got. So it's $350,000. And the denominator here is the equity, the book value of our equity. So that's $5 million. 1, 2, 3, 1, 2, 3. Let's cancel some zeros out. So it's like 35 over 500. 35 over 500 is the same thing as 7 over 100. So it equals 7% return on equity. And that's interesting because, well, why that's lower is even, well, I don't want to go into too much depth just because I realize I'm already pushing my time limits. But at this point, you should have a good understanding of at least a basic income statement of of kind of a company that sells widgets. And in the future, we're going to look at a lot of different companies, financial companies, insurance companies, natural gas pipeline companies that will have very different looking income statements. But this gives you the general template for how things work. And at least will give you a sense of how revenues, gross profit, operating profit, pre-tax income, and net income really are different. And it's, a lot of times in the popular press, they're all jumbled up as just kind of the company is making this much money. Anyway, I'll see you in the next video.
Okay, this video number 2, the income statement is saying how much the company made earning. The information is consistent. The income statement made on 1 year or 6 months.
So in today's video, we're going to take a look at balance sheets. Now, in a previous video, we've looked at what is profit. And a lot of investors look at profit and loss accounts, and as long as profit's rising, they think, great, this is a company I want to buy. But actually, that can be a mistake. You need to look at the balance sheet as well. It's not the most exciting document to read. It's got a lot of numbers and a lot of jargon in it. But without a balance sheet, you can't really get a sense for what a business is maybe worth and what its therefore for long-term prospects are. So this video is all about what balance sheets are for and the very basic types of information you can expect to take away without getting buried in the jargon and the accounting buzzwords. Okay, so where do they fit in? Well, accounts basically can be divided into 3 important statements. Buried right in the middle of the 100-page document we call a set of accounts, you'll find a profit and loss account, a balance sheet, and a cash flow statement. So let's take a look at those first 2. In essence, what you've got is this. Every 12 months, the directors will prepare a balance sheet. As such, it represents you freezing the business and taking almost a photograph of where it's at right now. And you'll notice the balance sheets are prepared at specific dates. So, for example, you might have a balance sheet prepared at the 31st of December for a particular year, say 2010. Another popular one is the end of the tax year for companies, so quite often you'll find 31st of March 2011, let's say. The point is, the directors pick a point in time, the end of the trading year, if you're a retailer, for example, sort of around Christmas time, let's say, or the end of the tax year. They're quite popular, but certainly not the only options. And you prepare a snapshot. See balance sheets very much as taking a photograph at one point in time. Now, as such, it's a slightly artificial exercise. Balance sheets are out of date almost as soon as they're prepared, because of course in reality businesses don't just stop, they keep going. But nonetheless, as a quick snapshot of what a business might be worth, balance sheets can be quite useful. And usually they're prepared at 12-month gaps to keep the accountants happy, with possibly an interim statement somewhere in between, say every 6 months or even every 3 months. Now, just worth noting that although we're going to focus on balance sheets, if this is a 12-month period, a profit and loss account is more of a story. It tells the tale of how the business got from here to there. And hopefully the answer is by making profits. In other words, the business grew. So, although this video isn't about profit and loss accounts, see the profit and loss account as more like a cine camera, capturing everything that's happened and summarising it between two balance sheet dates, when the balance sheet is a photograph. So the language of profit and loss accounts is sales, revenues, minus costs, to give you a profit. It's a story. Sales will have been made January, February, March, April, May, and so on. Costs will have been incurred, and they're just summarised for each 12-month period. But really, for a sense of what the business might be worth to an accountant, let's say, you want the balance sheet, a snapshot. So, what is a balance sheet? What makes it different to this thing, the profit and loss account? Okay, well, basically, balance sheets are simply quick snapshot statements of net worth. So, sounds very flash, actually very simple. As Tim Bennett, I could draw up a personal balance sheet. I could start to list right now what my assets are, what I own, so a property, some cash in my pocket, and so on. Then I've got some things I owe other people. So my net worth isn't my property because I'm forgetting there's a mortgage on it. So actually, if I sold my property tomorrow, all the cash isn't mine. I'm not going to sell it tomorrow, but if I did, I'd have to pay back a mortgage first. So actually the net bit I own is a bit smaller. And then perhaps I remember that I owe my mate 20 quid from last week down the pub. So I've got to think about repaying him at some point. That's called a liability, an amount I've got to pay back at some point, even if I don't do it now. So I could start to think about my personal net worth in terms of the assets I own, and some of them will be long-term and short-term, and the amounts that I owe other people. Some of those are short-term and long-term. My mate's debt, I'll pay him back next week. That'll be gone in a week. But my mortgage, that's not going to be gone for 20 years. So some of my liabilities are short and long-term too. And my net worth is presumably the difference. And that'll increase or decrease depending on which day of the week you ask me to do it. And that's roughly what companies do. A balance sheet is simply a statement, if you like, of what they own minus what they owe other people at, let's say, the 31st of March. The difference is known, not surprisingly, as the net position. And then at the bottom, the reason they balance is you answer the question, how has that net position been funded? Balance sheets balance because those two numbers should be the same. In other words, you can't conjure net worth out of thin air. It'd be nice if you could, but no one I've yet met can do it. In other words, somebody has funded that net position. So maybe I started my whole personal balance sheet as Tim Bennett. How did I ever go to a bank to afford a property? Perhaps my father gave me some money to get me going, and with that I put the deposit down on the property. That allowed me to borrow, and so on. Now, companies don't have friendly dads who give them money. Well, some do, but normally they have shareholders. So how the whole thing been paid for is normally called shareholders' funds. And the balance sheet balances because the company's net worth is equivalent to what shareholders have put in, plus any profits the company has made since it started. So, taking this a step further, companies use jargon at this point to explain what they own, but the jargon shouldn't put you off. So for example, they'll break their assets into fixed, slightly confusing term, and current. In other words, just like I did with my personal balance sheet back there, companies own some things long term. Fixed doesn't mean nailed to the floor. It means stuff we're going to keep for more than a year from the balance sheet date. So it includes land and buildings, plant and machinery, vehicles, that kind of stuff. Current assets, short-term assets, the stuff that if you did this exercise in a year's time, it's probably all going to be gone, or at least have changed. So cash, stock in the sense of the stuff the company makes, for example, raw materials, components lying around if it's a car manufacturer, for example, and also receivables. So, for example, if you lend someone £100 down the pub and you were to draw up a personal balance sheet, that'd be a little bit of a sad thing to do, they owe you the money in your books. This would be the sad bit. That would be a receivable. And if you didn't think you would receive it all, you'd write some of it off. Anyway, so companies have things called receivables as well within current assets. So these are the sort of accounting headings that you start to see. And also, companies like to break what they owe to external creditors, so banks, for example, and other lenders, into short-term amounts due in less than 1 year, and long-term amounts where realistically we'll be paying it off in more than 1 year. So for me, an overdraft, for example, is a short-term creditor. It's an expensive way to fund a business long-term. It's an expensive way to fund Tim Bennett long-term. But a personal loan for me, or a 10-year loan for a company, that falls into creditors due in more than 1 year. And that's just a bit of jargon. Debtors or receivables are current assets. That's people who owe us money. Creditors, amounts that we owe other people. But nonetheless, even if you break it down into 4 numbers, those are positive because they're assets, those are negative because they're liabilities, you still end up with a, hopefully, net asset position. Now, down here, funding, as it's called, breaks down, broadly speaking, into share capital and profits. In essence, what we're saying is, in the past, in order to build the business, the company's probably sold shares to external shareholders. That funding is represented here as share capital. And also over time, hopefully the company's been trading profitably. Every 12 months, that profit statement is positive. And if you run a positive profit statement for, say, 10 years since you started the business, you'll have 10 years of accumulated profits, assuming you haven't paid out dividends, and all of that ultimately belongs to the shareholders of the business. So the shareholders' contribution sits at the bottom of the balance sheet, and this is a simplification, but it's split, broadly speaking, into amounts the shareholders have put in to fund the business and the accumulated profits that if the business was liquidated tomorrow, so the theory goes, they would receive. Now, just going to finish with the reason balance sheets balance. Just to give you a flavour for that, they always balance, and that's because accountants have a habit of recording everything twice, which forces them to balance. So what that means is when you look at the balance sheet, that number is the same as that number, or that number is the same as that number. And the reason is simply this. If, for example, I were to borrow £100 as an accountant, I would raise my current assets by 100 cash, and I'd also raise my current liabilities by 100 because I've got to pay it back at some point. Net effect, 0. Or if I ask my shareholders for some more cash, share capital rises to reflect their contribution by, say, 100, and cash up here rises by 100. That's up 100, that's up 100, the whole thing balances. So this isn't a bookkeeping course, but because accountants record everything twice, balance sheets always balance. That doesn't matter too much. What's more important is to realise that the top half represents net ownership of assets at a snapshot point in time, and the bottom half represents how that's all been paid for. Now, as an investor, what are the takeaways from this? Number one, don't just look at profit and loss accounts. that's dangerous, because a company may make one-off profits one year, but what about the longer term picture? For that, you need a balance sheet. The balance sheet is also the place where you'll find hidden nasties that are simply not in the profit and loss account. For example, there's a note that supports the balance sheet called contingent liabilities. It's written, and it's quite a long way after the balance sheet, and that reveals liabilities, nasties. So it's in this little section here that the company hasn't yet recorded on the balance sheet but might become a problem in the future. Lawsuits, for example, outstanding at the balance sheet date. And also, if you're looking for what's the business worth, whilst a balance sheet isn't fantastic because it's out of date and it's prepared according to accounting rules, so assets are often recorded at their historic cost, not always at their current market value, it's a good starting point. A profit and loss account will not tell you what a company's worth. It just tells you what 1 year's profitability looks like, but a balance sheet is at least a starting point for getting a handle on, essentially, the value of the entire business.
Okay, this is my presentation. As I bring my accounting English forum to a close, once again, thanks for allowing me to be here this evening, and hope that this activity has given you a much clearer understanding of how to apply accounting equation in English. I will welcome the opportunity to return with another group of students to present a different accounting English forum topic in the near future. Thank you for watching.